Good morning and welcome, Patriot Radio News Hour. Joe and Jason live on this Monday, the 13th of March. March Madness, right? The brackets are out. Did your team make it? Is Cinderella gonna have her dancing shoes on? But you know what? It's starting to become a theme, isn't it? March Madness happening in the financial markets. This started last week. Silicon Valley Bank over the weekend. We begged them. I told you all on Friday, Janet Yellen and Jay Powell better do something really, really big, because this is, I'll just tell everybody, this is not a complicated problem. This is simple math. And these banks are vulnerable because all of those off-balance sheet securities are underwater. We'll explain it all to you. We'll go through what they've done. Here's the good part. Early on Sunday, they talked real tough. By Sunday afternoon, they had a change of heart, and we'll go over that. Plus, they also closed Signature Bank. So that was one of the banks on the watch list now. 3 banks in the last week now have been closed. We'll give you all the details. 800-951-0592. allamericangold.com is the website. Gold is flying right now, up another $50. Well, $48, $1,915. Silver, remember how we talk about gold and silver are brothers? Silver's that little brother. Sometimes he lags behind. Right now, silver sprinting to catch up to big brother here, up $1.40 right now. But here's the great part. It is Monday. Monday, we normally have my son Joey, who works at Northwestern Mutual. He has been on our program really now pretty steady for over the last year and a half, trying to get people to get their portfolios in order, because he's been warning about another big loss, following last year's losses on Wall Street, another big round of losses they were anticipating coming this year. And Joey, it sure looks like this thing kind of came out of nowhere. Everybody was talking about disinflation, and then, oh, wait, it didn't happen. And next thing you know, we've got bank runs.
Yeah, I mean, the news did come out of nowhere, but when you think about it, and like you said before, it's not complicated, it makes sense, right? The market was down. Inflation was crazy. These banks are investing in, risky assets, their bonds, their safe money, digits. Banks are risky. They don't keep all of your cash in there. They invest it to make their money. And then when things like this happen, especially a big bank like Signature Bank, big in VC funds, and Silicon Valley, they really made sure they went through everything. Bank runs are happening. And with that, the market's going to go down, especially with these bank stocks. And people's 401ks are at risk. And we need to make sure that we're following what's going on in the financial market, in our political land space. And until the Reserve takes back these interest rate hikes, we could very well see more banks go under.
Okay, so there's a big call right there. There's a lot of talk about the Wednesday meeting based on the inflation data that had come in so far, and I think we're going to get some tomorrow. But remember, the Fed meeting starts tomorrow. We're going to know on Wednesday. People were talking 50 basis points up until what happened on Friday. I know Goldman Sachs is saying, hey, they shouldn't raise at all, but it's hard to imagine them not raising at all with what inflation's been doing. But Joey, pretty simply put, the higher the rates go, the more bank failures we're going to see. Isn't that kind of what the logical thinking is on this?
Yeah, that's 100% the logic. Increase the rates, the market is down more. Investors are now wanting to get their money out of there, and then all of a sudden, these banks don't have the money or the capital on hand. They're investing it all. And then on top of that, the FDIC is only insuring $250,000, and that's not true for every bank. Smaller banks may not have that insurance.
Say that again, Joey. I think you broke up on us, at least on my end.
Yeah, sorry about that. They continue to raise these rates. I mean, we could very well see more banks fall under, and it's important to note with the FDIC insurance level 250. I know a lot of people show aren't with big banks. Smaller banks may not have that full $250,000 of insurance for them. So I urge listeners today, check with your bank, see how much they're actually insuring you so that you know.
Yeah, and then today, well, really last night, the big announcement that the two banks that failed last week, Silicon Valley Bank and Signature Bank, the FDIC is saying, hey, everybody's going to get their money, no matter if they're over or not, and we're going to use the FDIC fund to do it. Now, that fund only had $125 billion in it. We knew Silicon Valley Bank had about $23 billion in insured deposits, so that puts the fund at about $100 billion. We know that they're going to take losses on the securities, but we're sitting here. By the time they keep those two depositors whole, the FDIC, Joey, they can be down to like $70 billion. They're probably a couple of banks away from not having any more money at all. Eight 800-951-0592. Joe and Jason here on this Monday. We have Joey with us talking about these banks. Boy, Charles Schwab down another 20%. Of course, they're also one of these companies that potentially could become a victim of all of this. But Joey, again, not operating out of fear. If people haven't, they don't have that advisor, if they haven't been talking to the right people, chances are their portfolio is taking another big unnecessary hit. But this is what you're saying. Hey, let me help you get it right so you don't have to take these big losses. And you know what? Then you don't have to operate out of fear, which right now a lot of people are operating out of fear.
Yeah, and the last thing we want is for people to make financial decisions based off of fear, right? And a lot of things that you see happens, people get so crippled by it that they actually end up not doing anything about it because they just don't want to think about it. A year passes by, you check your account, and you take so many unnecessary losses or hits, and quite simply, people need someone in their corner. There's just too much going on for the everyday person to work every day, 8 hours a day, come back home to the family, take care of their personal business, then also keep track of everything that's going on, especially in the marketplace with all the smoke screens and fancy rhetoric, Federal Reserve. We need to make sure that we're properly allocated so that we don't have to operate out of fear. You know, a lot of people work with Fidelity or through their bank. You call a different person every day. There's no personal aspect or relationship to it. They're more seeing you as a cookie-cutter spreadsheet. We did it 1 year. We send them an email, an account statement, and that's about it. Or would you rather have someone who has a team with them looking behind the scenes every day, 12 hours a day, making sure we're properly allocated, and then when it's time to make adjustments, review some planning, review what's going on, you have us reaching out to you. We're not people where you have to reach out to us. We reach out to our clients at least twice a year. A lot of my clients like me to reach out at the beginning of every quarter just to revisit things. Life can be crazy. Goals change. Personal experiences change. Income changes. But all of these are factors to your financial plan. And for a lot of people, all they really have is 1K or retirement accounts through work. So by letting your accounts be subject to losing 20% and all these risks is just unnecessary. Now, at the very least, let's review everything you've got going on. Take a look at that portfolio and make some adjustments. and make sure that we're not taking on too much risk. That's as a lot of people are entering retirement or people are starting a family. We want to make sure we're doing things right, and the earlier we can implement these things, the better off you'll be, and then you don't have to go to bed worrying every night, having fear for what's going to happen in my financial markets, what's going to happen with my investment account. Knowing you've got someone and a team behind you that's going to do what's best for you.
Yeah, you bring up some great points, and today people don't realize how close this was. I was telling Jason earlier, we got real lucky, and it's still going to happen, unfortunately, but the Dow could have been down 4,000 points right now. And no offense, but they sent Joe Biden out there today, and I've been talking a lot about we've got such a weak head of the Fed in Jay Powell. We've got a weak guy in office in Joe Biden. Joey, they don't exactly give off confidence, and this is a big problem because confidence has a lot to do with what happens to equity prices.
100%. When investors lose confidence, they're taking their money out, even if they're selling at a loss. And then you see the bank runs happen. Then you see the market go down. There's no investors. There's no money going into the government. And it seems like our leaders are lacking that confidence aspect. I listen to them talk. I don't believe in them. They don't sound too confident. To me, it sounds like they don't know what the heck is going on. Right? And when that happens, well, we see financial markets like we're seeing today. And I agree with you. I'm surprised the Dow isn't down more. Definitely see that in the future, or it goes down even more.
Yeah, and again, we're seeing this massive drop in bond markets. Bond markets haven't done this. I mean, the only time bond markets have fallen like this, the 2008 crash, the 87 crash, right? This happens these are crash type moves in the bond markets, which Joey kind of relays what you're saying. All the big investors, they're trying to get out right now.
Yeah, they're trying to get out, and it's your quote unquote safe money for everyone's portfolios, 401ks, is bonds. They're down double digits in 2022, along with equities. Right, that was even worse than 2008. There was no safe place to hide in the market this last year. There's nowhere to hide. You were down money. But if you were taking on too much risk in all these crazy aggressive sectors where you're 100% in bonds, you probably lost 12% in bonds. You lose 20% in equities. Right? You have no safe bucket of money. And that's where the planning comes in, where we really help people. How do we make sure that we're recession-proof? If you go to retire, you retire at age 60, age 65, you live for 30 years to age 95, every 15 years, we're going to get some form or type of a recession where we have down markets, where your accounts, if not managed correctly, down 20%. All of your money is in investments. Well, you lost 20% of your money that year. How do we make sure that we implement other strategies along with these 401ks and investments where you have money growing not only outside the market, but also in a tax-efficient manner? Right? And then also here comes the thing with rebalancing. 401ks down 20%. Well, how do we restructure that? Take some stop-loss capital gains, right? Reduce your taxes, write it off, and then implement a better strategy. I want people to know, do not have fear, have optimism for the future, and let's get some things situated. Let's get things straightened out so that we can, make a bulletproof financial plan and make sure at the end of the day, as we're entering retirement or we're thinking about retirement, hey, we know what to expect. We know that, hey, when the worst case happens, we're covered because we plan for it.
Joey, give out your contact information real quick.
Yeah, reach me at my personal cell, 602-909-9048. Again, that's 602-909-9048. Shoot me a call or text. If I don't get back to you, I'll reach out as soon as possible. And let's just start reviewing things and getting some good things in place and get us back on track.
There you have it. There you have it. He's here to help you guys. Reach out to Joey. Get ready. It's going to be another bumpy ride here. We'll have Joey back with us next Monday as well. And you can always go out to the 1360khnc.com website, go to the sponsor page. All of his information is there as well. And I want to thank Joey for taking the time to be with us today. But Jason, again, we're seeing this massive drop in the bond market, and he is really talking about here. We've only seen these types of really crashes, for lack of a better word, which means everybody's running for cover. The 08 crash, the 87 crash, right? These are crash type markets. And I think people got to get ready because that's probably the most likely scenario is we've got another big leg down here in equity.
Yeah. I found it interesting. I was looking at some numbers and charts, and I was looking at bank failures numbers per year. And I found it's just interesting. I don't know if it's just a fluke or if this is just a pattern, but in 2005 and 2006, there were 0 bank failures. So the years before that, there was a few here, a few there. In 2007, there was 3, and then it just started snowballing every year after that. 2010 was abysmal. In 2021 and 2022, we had 0 bank failures, and now here it is. We're getting a few sprinkled in, Joe. So it's very eerie what's going on.
Yeah, and the sad part is this was still the good times. This really confuses what's going to happen on Wednesday now. Citigroup says 1/4 point. Goldman says none. The realities are, I think 50 basis points, which is what we needed, is off the table. But everyone's got to understand the higher the rates go, the more likely we have more bank failures because of math. It's just math, and you got to understand. So they said, hey, listen, we're going to insure all the deposits at both of these financial institutions. It doesn't matter. And a lot of these, here's the problem now. Businesses tend to have, and unless you're really a small business, any just a regular sized business, you tend to have more than $250,000 in the bank at any given moment in time. And the realities now are, do I risk leaving it in these smaller banks? And Jason and I were talking about this today. It just doesn't seem like that's a good risk. Like I really think we're going to see a lot of these businesses move to those big 5, 6, 7 banks and for quote unquote safety purposes. And the problem, Jason, is these smaller banks are very dependent on a very small amount of major depositors. They have 5 or 10 major depositors leave their bank. All of a sudden, that's a bank run for them. And then they've got to go and sell these equities that are underwater. And next thing you know, they're insolvent.
Joe, we're no different in some ways that we have big customers and we have small customers, and you don't really want to lose either one. But when the big customers jump off the ship for these banks, it's tremendously stressful, if not backbreaking for them. And that's what's happened. That's exactly what happened to Silicon Valley Bank. A couple of people figured out, it's funny that the CEOs of that bank, they were selling their stock last few weeks. They knew it was coming. Everyone knew it was coming, Joe. But the smaller guys in the boat, they're going to be the losers, Joe.
I don't know if that they knew or not, because so far I haven't heard anything about, there was some underhanded bad accounting, right? It appears, now that may come later, but right now it appears that both of these banks were following the guidelines that were laid out by the central bank, by the SEC. And guess what? The realities were deposits left the bank, and all of a sudden, here comes the bank run. And now we're sitting here in a situation where for a lot of these smaller banks, think about it, the stress test banks, most people don't know this. I want to say there's only 8 banks that get stress tested. That's it. This was a bank that had $178 billion in it. That's not supposed to take down the financial system. Right? It was only the too big to fail banks that were supposed to take down the financial system. And yet here it was. Guess what, guys? That was a load of crap. That was a load of crap. And now think about this. We've got 4,000 banks, and I'm telling you, only 8 get stress tested. These other, the other remaining 4,000 banks, they said all of them need to be worried, because if depositors make this choice of, it's just not safe. I just don't want to, I don't want to be the guy caught holding the bag and all of a sudden I can't make my payroll. I don't want to be that guy. I'm going to move these deposits. This is the scary situation. This is why they told everybody, hey, we're going to keep everyone's deposits are good, because if they hadn't, believe me, this morning, it would have been chaos. And Jason, unfortunately for them, I don't think that's enough, because most people, we're not buying it. Patriot Radio News Hour. We'll be back after the break.